Imagine leaving your house key under the exact same doormat every single day, right? But you're
Yeah.
fully aware that a supercomputer is just walking down your street, flipping over every single mat in the neighborhood.
Oh, man.
Yeah, eventually it is going to find your key. And today, that is the terrifying reality for about 4 million Bitcoin.
It really is.
Welcome to NovaStream, your 24/7 streaming channel for live financial markets, global indices, and breaking news. If you are tuning in right now, pull up a chair. We always consider you the third person sitting right here at the anchor desk with us.
Definitely. Looking at the same screens, trying to make sense of a world that is just moving incredibly fast today.
So fast.
Yeah.
And our mission for this segment is to basically cut through that noise, right? We want to deliver the highlights of the day across our live crypto markets, the global financial indices, and of course, the breaking news feed.
Yeah, we've got a lot to cover.
But as we were looking at the charts this morning, a very clear, very unsettling theme started to emerge. Because whether we were talking about the Federal Reserve or an $80 billion corporate flex from a tech
Which
giant,
is huge, by the way.
huge, or, rapid fire troop deployments, or that massive quantum computing threat to Bitcoin I just mentioned, everything today seems to be defined by a massive, desperate search for security.
Right. People, institutions, they're all realizing just how fragile their systems are.
Yeah, and they're scrambling to build a moat. Okay, let's unpack this. We have to start with the center of the financial universe, right? The Federal Reserve.
Yeah, which is currently caught in a fascinating and frankly a pretty terrifying tug of war.
Totally.
We have sky-high market expectations pulling one way and then some very grim historical indicators pulling the other.
Right. And today, Kevin M. Warsh is officially being sworn in at the White House as the new Fed chair.
Which is a big deal.
It's a massive optical shift. It is the first time in 40 years a Fed chair has been sworn in at the White House rather than, the Fed headquarters.
Yeah, it definitely sends a heavy message about presidential oversight.
It does, and President Trump tapped him with the explicit expectation of cutting interest rates. But the economic backdrop Warsh is walking into is just wild.
It is. Because the central bank is quietly floating the reality that rates might actually need to go up to hit their 2% inflation target.
Yeah.
The friction here is all about the absolute contradiction in the data we're seeing right now. On one hand, you have Warsh in the bond markets sweating over rising inflation.
Which is driven by the commodities, right?
Right. That fear is driven heavily by surging commodity prices,
Yeah.
which are directly linked to the ongoing war with Iran. But then, and this is where it gets confusing, almost at the same time, we get a report tracking Asian markets that noted U.S. inflation dropping to 1.4%.
Wow.
Yeah, which actually eased some of the pressure on bonds. So it's like a dual reality, and the market simply doesn't know which one to price in.
No, but if you look at the global financial indices, the smart money seems to be preparing for the darker reality.
Yeah, they are.
We saw a major warning come across the feed from Zweig de Mena. They are a hedge fund with a 40-year track record, and they are warning of a potential 15% drop in the S&P 500.
Yeah, that caught my eye too.
Their proprietary inflation indicator just hit 72. That is a level we have only seen 3 times in the last 15 years, like 2022, 2018, and 2012.
Right. And if we connect this to the bigger picture, you have to combine that inflation indicator with the famous Buffett indicator.
Oh, yeah.
For those of you watching the feed, the Buffett indicator tracks total stock market capitalization against the country's GDP. And that metric just hit an all-time high of 230%.
Wait, let's just pause on that because that number is staggering. 230%.
Yeah, it's wild.
When the stock market is worth 230% more than the actual goods and services the country produces, it means we're essentially trading on pure imagination, right? We are completely detached from economic reality.
That is a great way to frame it, actually. You are trading on the expectation of future perfection.
Right.
What Zweig de Mena is pointing out is that we are drinking a pretty toxic cocktail right now.
Right.
You have rising consumer prices, technically robust economic data, and incredibly high valuations fueled by that imagination you just mentioned.
The expectation that everything just keeps going up.
Exactly. And historically, when you have inflation rising inside an economy that looks strong on paper, it inevitably leads to a severe equity downside.
Mm-hmm.
The bubble pops.
And what pops the bubble is the cost of borrowing. Swagdemena says that 10-year Treasury yields, which are, sitting around 4.6% right now, actually need to jump to
That's
5.8%.
to properly compensate investors for this ongoing inflation risk.
Yeah, we talk about the 10-year yield all the time on this channel, but let's make it tangible for a second. It feels like the market is a sports car redlining down the highway, but the dashboard is lighting up with check engine warnings.
Hmm.
If we see a sudden leap from 4.6 to 5.8%, what's the domino effect? Like, what actually breaks first in the broader economy?
But the 10-year yield is essentially the gravity of the entire financial universe. When it goes up, gravity gets heavier.
Mhm.
If it jumps over a full percentage point to 5.8, the very first thing that breaks is corporate debt refinancing.
Mm.
So imagine a mid-sized company that borrowed $100 million of cheap money a few years ago. Suddenly their term is up, and they face massive spikes in interest payments just to keep their doors open.
Right, so they can't afford to build new facilities, they freeze hiring, maybe they lay people off.
Precisely.
Mm.
And the next domino is the consumer. Mortgage rates, which are directly tied to that 10-year yield, would just skyrocket past 8 or 9%.
Wow.
That freezes the housing market entirely, which crushes construction, home goods, real estate services. The shockwave essentially chokes off capital for any business or consumer that relies on borrowing.
Which is everyone.
Right. In our current system, it's nearly all of them.
So when gravity gets that heavy and systemic fragility is that high, you have to build a fortress.
Which kind of brings us to how the biggest companies in the world are maneuvering in real time. Look at NVIDIA.
Yeah, talk about a fortress.
Right. They just announced an $80 billion share repurchase program. $80 billion. To put that in perspective, that is the largest buyback authorization for any company ever, aside from Apple.
Yeah.
Plus, they bumped their quarterly dividend up to 25 cents.
Mm.
They are projecting absolute unstoppable strength.
Yeah.
But I have to push back on the narrative here a little bit.
Okay, let's hear it.
Is an $80 billion buyback genuinely a sign of confidence? Or does it just mean a tech giant has run out of new, innovative things to spend its cash on?
It's a phenomenal question, really, and it gets to the heart of corporate mechanics. When a company is generating the kind of swelling, massive cash flows that NVIDIA is right now,
Right.
R&D can only absorb so much capital before you hit a wall of diminishing returns.
Right.
I mean, you can only hire so many top-tier engineers.
Right. You can only physically build so many data centers at once due to supply chain limits.
Mm-hmm.
So mechanically, handing it back to shareholders is the next logical step.
But some analysts were clearly hoping for more, right? Like maybe a massive strategic acquisition to expand their footprint?
They were, yeah. But the broader context here is defensive. In an uncertain market, buying your own stock is a way to artificially put a floor under your share price.
Oh, I see.
By reducing the number of shares available, you make the remaining shares more valuable. It is literally a moat-building exercise.
Especially when the geopolitical environment is making everything so unpredictable right now. I mean, we look at the commodities board today. Brent crude is sitting at $104.08 a barrel.
Yeah.
And U.S. crude is at $97.25.
Which feeds right back into the inflation fears we just dissected. Those oil prices are heavily driven by the Iran war and the ongoing shipping disruptions in the Strait of Hormuz. We're seeing diplomatic talks between the U.S. and Iran just drag on with zero firm resolution in sight. And without a ceasefire, that massive oil premium stays baked into everything from manufacturing to the cost of shipping a package to your front door.
It's unavoidable. And the geopolitical whiplash is not just in the Middle East. Just when you think you have a handle on global military posture, the breaking news feed throws a total curveball.
Right.
We just saw President Trump abruptly announce the deployment of 5,000 U.S. troops to Poland. And, regardless of where anyone sits on the political spectrum regarding global deployments from a pure market mechanics standpoint, this level of whiplash is exactly why we're seeing capital flee to defensive positions today.
It is the definition of unpredictability. The data here is stunning. This announcement completely blindsided the Pentagon.
Yeah, they had no idea.
Just last week, the Defense Department had abruptly canceled the deployment of over 4,000 troops to Poland. That cancellation was supposed to be part of a broader, structured drawdown in Europe, meant to return forces to 2022 levels.
Right. And the rationale given for this sudden reversal, the president tied it in a social media post to the successful election of Polish President Karol Nawrocki,
Right.
a candidate he endorsed nearly a year ago. So now military commanders are scrambling to figure out the logistics. Like, do they have to cut troops somewhere else to meet the broader goal of reducing the 80,000 forces currently in Europe?
Yeah, it's a logistical nightmare.
When policies change by the hour based on political outcomes rather than, long-term strategic white papers, predictability vanishes.
It does. And when fiat markets and global stability lose that predictability, we historically see capital pivot to digital safe havens.
But here is the massive irony of the day. The supposed digital safe haven from all this fiat chaos is facing an existential security threat of its own.
Yeah, this is huge.
Let's look at the live crypto markets. First, the more traditional market mechanics. XRP is struggling. It is currently trading around a longo 36 cents.
Yeah.
Over the last 90 days, it is down 3.31%. That matters because it is the only top 5 crypto in the red over that same period. I mean,
Right.
Bitcoin is up almost 15%, Ethereum is up nearly 9%.
Right.
Why is XRP lagging so badly while the rest of the market runs?
What's fascinating about XRP is its behavioral pattern as an asset. It acts almost exclusively as a high volatility, catalyst-driven token.
Okay.
It spikes aggressively on positive regulatory news, but then it bleeds out just as quickly due to intense profit-taking. It simply lacks the sustained underlying demand that Bitcoin has.
We saw that with the Clarity Act, right? When the Senate Banking Committee cleared the Clarity Act, XRP immediately bumped up to $1.54.
Right.
It looked like a breakout, but then it faded right back down.
Yeah, because a news headline doesn't buy tokens. Capital does. For XRP to actually reach its $3.65 cycle high again, it cannot rely on speculative bursts. The on-chain analysts are looking at ETF data. XRP needs sustained exchange-traded fund inflows above $100 million per week. Without that steady institutional buying pressure, every rally is just going to keep fading as early holders sell the news.
Right. Okay, so XRP is dealing with basic supply and demand mechanics. But Bitcoin is facing something that sounds like it was pulled straight from a sci-fi thriller.
It really does.
A new report from Glassnode reveals that over 30% of Bitcoin's circulating supply currently faces at-rest quantum exposure.
Yeah.
Let me set the stage here. The U.S. government just injected $2 billion into quantum computing development across 9 companies. And this massive capital injection has completely revived the fear that something called Shor's algorithm could crack Bitcoin's underlying cryptographic security.
This is a monumental foundational issue. Let's break down the mechanics. Bitcoin secures your funds using something called the elliptic curve digital signature algorithm, or ECDSA.
Okay, the standard encryption.
Right. Think of a public key as your mailing address, and your private key as the physical key that opens the mailbox. Right now, it is mathematically impossible for a traditional computer to look at your public address and guess your private key. The math is just too complex.
But a quantum computer changes the rules of math.
It does. The fear is that a powerful enough quantum computer running Shor's algorithm could look at a public key on the blockchain and instantly reverse engineer the private key.
Wow.
And if they have your private key, they have your Bitcoin.
Yeah. And Glassnode broke this down into 2 types of exposure, right? Structural and operational. Structural exposure accounts for about 1.92 million Bitcoin. These are inherently exposed by design.
Yeah, there's not much you can do there.
Right. These are things like Satoshi Nakamoto's early stash or very early primitive wallet structures from the dawn of the network. There's not much anyone can do about those.
But the much larger issue is operational exposure, which accounts for 4.12 million Bitcoin. Yeah, this exposure is entirely caused by poor user habits, specifically something called address reuse. Whenever you send Bitcoin from a wallet, your public key is permanently revealed on the blockchain.
Okay.
If you keep using that same exact address to store the rest of your funds, that balance sits there with its public key fully visible, just waiting to be decrypted by a future quantum machine.
Which goes back to that analogy we started with. It's like leaving your house key under the exact same doormat every single day. A quantum supercomputer is just walking down the street, flipping over every mat.
Exactly.
But here's the thing that really caught my eye on the data feed today. The exposure among the major multi-billion-dollar crypto exchanges is wildly uneven. Coinbase is sitting at just 5% exposure.
Right.
But Binance is at 85%, and Bitfinex and Gemini are sitting at a terrifying 100% exposure. Wait, back up. I'm looking at these numbers. How is that even possible if they are running on the same fundamental blockchain? What is Coinbase doing differently behind the scenes?
It all comes down to how their back-end infrastructure manages something called UTXOs, or unspent transaction outputs.
Oh, okay.
To carry your analogy further, What Coinbase is doing is essentially forcing you to move to a brand new house with a brand new lock every single time you spend a dollar.
Oh, wow.
They have engineered their hot and cold wallets to aggressively rotate addresses. They never leave large balances sitting in an address that has already broadcast a public key to the network.
And the others.
Binance, Gemini, and Bitfinex, according to this analytical framework, are seemingly recycling addresses for their internal transfers or user deposits.
Yeeks.
They're leaving the key out, which flags those entire massive balances as theoretically vulnerable to a quantum attack. Now, the ultimate fix for all of this is something called lattice-based cryptography.
Which sounds incredibly intimidating.
It sounds like sci-fi, yeah. But imagine hiding your secret private key in a complex multidimensional grid of thousands of dots instead of using a standard math equation. A quantum computer can solve the math equation instantly, but it gets completely lost trying to navigate the grid.
But getting the entire decentralized Bitcoin network to agree to a massive years-long soft fork upgrade to implement that grid, that is a colossal political hurdle.
It is.
The clock is officially ticking. All right, let's step away from cryptographic grids and look at a couple of highly discussed items from the breaking news feed that impact international law and local wallets. And again, as we look at these geopolitical stories, we are purely examining the legal mechanics and factual developments here.
Right, we are dissecting the friction points between policy and law.
Yeah. The first story is a major legal skirmish involving the weaponization of economic power. The U.S. government just removed UN Special Rapporteur Francesca Albanese from its sanctions list following a direct order from a federal judge.
Yeah, this was interesting.
Now, she was originally sanctioned by Secretary of State Marco Rubio for engaging with the International Criminal Court regarding their arrest warrants for Israeli Prime Minister Benjamin Netanyahu and Defense Minister Yoav Gallant.
The legal mechanics of this ruling are absolutely fascinating because they test the boundaries of global finance.
How so?
Well, the U.S. does not recognize the ICC's authority.
Right.
Secretary Rubio argued that Albanese was essentially trying to investigate or arrest U.S. or Israeli nationals without proper consent, and he used economic sanctions as a tool of soft power to penalize her.
Right.
But Judge Richard J. Leon of the district court stepped in and issued a preliminary finding that these sanctions violated her First Amendment rights.
Because, as the judge wrote in his ruling, the only way she actually engaged with the ICC was by offering non-binding opinions and recommendations. Essentially, she was just speaking.
Yeah, and that is the massive insight here. The court is saying that a government cannot use the leverage of the U.S. dollar system, which is what economic sanctions are, to punish a UN official merely for voicing a legal or political opinion.
Even if that opinion is highly controversial to the current administration.
Right. The government has already appealed the decision, so this legal battle will continue to play out. But it is a monumental test of the limits of sanctions power versus the fundamental right to free speech.
It really is incredible to see how financial plumbing is used as a geopolitical tool. Okay, let's end our sweep of the feeds on a slightly lighter note regarding consumer purchasing power.
Sound good.
We have the 2026 World Cup coming to the U.S. this summer. Up until now, the headlines have been dominated by absolute outrage over sky-high ticket prices.
Oh yeah, they were brutal.
But if you look at the tracking websites today, secondary market prices are actually down 22% over the last 60 days. And New York City Mayor Zolan Mamdani just announced a massive localized relief program.
Right. A random lottery for 1,000 tickets to group stage and knockout round matches being held at MetLife Stadium.
And the cost if you win the lottery, just $50 each. Or, as the mayor proudly boasted to the press, the price of 5 lattes in New York City.
5 lattes.
Here's where it gets really interesting. I am starting to think the mayor's 5 lattes metric might actually be a more accurate, painful gauge of consumer inflation for everyday New Yorkers than the massive Buffett indicator we talked about earlier.
You might be right about that.
If a standard latte is hitting $10, maybe that 5.8% treasury yield we discussed isn't actually high enough to compensate for how fast our money is losing value.
It certainly puts a consumer purchasing power into stark, highly caffeinated relief.
Yeah, it does. So what does this all mean? We have covered a tremendous amount of ground today on the NovaStream feeds.
We really have. And if we synthesize everything we have watched roll across the screens today, that central theme we started with holds perfectly true.
The search for security.
Yeah. Whether it is the Fed battling the gravity of persistent inflation, NVIDIA hoarding its own stock to project a fortress of strength, global military forces shifting by the hour, or the Bitcoin network realizing it needs a massive upgrade against quantum supercomputers. Today's global market is entirely defined by a desperate search for security in a wildly unpredictable world. Investors, corporations, and global governments are all just trying to build a moat around their assets.
And that leaves us with a final thought for you to ponder as you watch the live charts today. We just spent a lot of time breaking down how a $2 billion quantum leap could eventually crack Bitcoin's blockchain cryptography.
Yeah.
But here's the real systemic kicker. If quantum computers can eventually break ECDSA math, how safe are the traditional banking systems, the global power grids, and the legacy stock exchanges?
Oh,
Because practically all of them run on the exact same foundational encryption.
that is the kind of underlying systemic risk that doesn't just show up as a red candle on a chart. It is the foundation itself.
It is something to definitely keep in mind. Thank you so much for joining us at the desk today. Keep it locked right here as NovaStream keeps the live crypto charts, global indices, and breaking news rolling 24/7. We will see you next time.